Welcome back, traders. This is Pipeline Trading. Today we're diving into key support and resistance levels, what I'm expecting for a pullback, and why the long-term trend is still your friend. Let's get into the charts. If you connect the major lows from 2020 through today, you'll see we're still holding the long-term uptrend. This trend line continues to act as dynamic support, and as the saying goes, the trend is your friend. I like to anchor trend lines through as many touch points as possible. It's how you identify meaningful zones. Right now, I'm anticipating a healthy pullback on the S&P. It's possibly down to 5,825, or even as low as the golden Fibonacci level, 5,459. This would form a corrective base, building support before the next move higher. And if that plays out, I believe we'll be on track for more new all-time high, by or in 2026. Looking at historical data, the market typically corrects 10% or more every 2 years and sees bear markets every 6. We've already had a 21% correction recently that qualifies as a cyclical correction, not a full-blown bear. I've been trading since 2009 and worked in venture capital and private equity with firms like Brookfield, Blackstone, and BlackRock. I don't show my face online because of the level of clients I've worked with, but what I share is based on real institutional knowledge. Now over to the NASDAQ. Same story. We're pushing into upper resistance levels. I use the Gaussian Channel here, a tool that behaves like a magnet. Price gets pulled back into it whenever it strays too far. I'm watching for a potential retracement to the 38 to 50% fib levels, somewhere between 21,200 and 20,000 to 64, before continuation higher. Looking at Elliott wave structure, we've likely completed waves 1, 2, and 3. We're now looking for wave 4, must stay above the top of wave 1, and wave 5 should extend us higher, possibly peaking into late 2026. In an uptrend, you don't want to trim too early. Instead, let the market show strength, set proper stop losses, and add on support bounces to grow your position. Now let's zoom out to macro. Despite what you're hearing, unemployment is falling, not rising. But history tells us, once rates start dropping, unemployment is on the rise after. Remember, rate cuts signal there is alarming data we have yet to see unfold. The ISM Manufacturing Index is also showing strength. It's climbing back above 50, a clear signal of expansion. I expect it to reach around 57. This supports the thesis that we're still in a bull market. Here's a chart most ignore: the Fed's balance sheet. When the Fed is buying, markets rip. They've been unwinding since March 2022, but when that flips, expect another major run. Finally, the VIX. It's been low for a little while, signaling there is greed in the markets. On the weekly chart, a breakout is forming. I expect a volatility spike by August or September, which could create ideal buy zones for long setups. To wrap it up, respect the trend, embrace the pullbacks, and build your position strategically. All signs point to strength. For now. But 2026 is the year I'll be watching for a full macro unwind. Adios. If this helped your trading view, drop a comment below. Want me to cover Fibonacci or Gaussian channels in depth? Let me know. Thanks for watching Pipeline Trading. I'll see you on the next chart. God bless you.